Very good evening, everyone. Welcome to our webinar today where we have OUE REIT with us. I'm Billy To. I'm the Head of Content and Investment Lead at ProsperUS. I'm also the SGX Academy trainer. So today we are very lucky to have Mr. Han with us. He's the CEO of OUE REIT, and it is very interesting because I think we've been writing quite a bit on OUE REIT for a while. I think the company, for those of you who do not know, have rebranded themselves from OUE Commercial REIT to OUE REIT this year. And at the start of this year, we've been talking about OUE REIT as one of the small cap pick for REITs players, right? So it's a lot of good narrative, a lot of story in terms of the recovery of tourism and how that will affect the REIT market, especially for OUE REIT, which has 2 hotels. I think they also have a retail space, the Mandarin Gallery, right? Yeah, so it's very interesting to see how they've been doing. So they've just reported their earnings results. For those of you who have been following, they've done pretty decent, I think, in terms of their earnings. But of course, I think the big disappointment is the decline in the DPU, right? So I think there's a lot of questions over there. Just a quick introduction to for those of you who do not know Mr. Han. He has over 26 years of experience in diverse international experience, having worked in Hong Kong, Singapore, Indonesia, and Brunei. So he's not a new face. If you talked to him before, I think last year or this year, I can't remember, but I think we talked to him before, so some of you might have known him. So if you want to ask any questions, please stay until the end, where you get to drill him with all the questions that you want. Just put it in the Q&A chat box and we'll take the question. All right, over to you, Mr. Han.
Thank you, Billy. Good evening, everyone. So I'll cover off a little bit about who we are very quickly, and then we'll talk about the first half highlights before we move through a little bit more detail in the performance, and then we'll have a Q&A at the end. So on OUE REIT, we rebranded from the OUE Commercial REIT to OUE REIT in January this year. This is to better reflect the fact that we have both hospitality, office, and also retail assets now. Total assets under management is 6.3 billion. We have 7 assets, so there's 1 property in Shanghai, the rest are in Singapore. So by portfolio value and income, nearly 93% are based in Singapore. We were assigned an investment grade rating last year by S&P, BBB- with a stable outlook last October. So that's a testament to the strength of our balance sheet. We've done a lot of work in 2022 and 2023, improving the overall operating performance, strengthening our capital structure. So S&P, which is a very well-established and probably the most blue brand of all the investment grade, all the investment rating agencies, assigned us an investment grade rating. So the key theme of our REIT really is, all our assets are located in very prime core locations. All the offices are in CBD. The Hilton Singapore Orchard, it's next to Takashimaya, opposite Paragon in Singapore, for those of you who know Singapore. The Crown Plaza Changi Airport, where we're directly attached to the Terminal 3 in Changi Airport, so it's a 100-meter walk after departure hall. So after arrival hall, you get out, you turn left, and then 100 meters, you're in the hotel. Okay, so we are very well balanced. And we have a barbell strategy going where 50% of our income comes from our office assets and the other 50% comes from our hotel and retail asset. Now, office assets are typically 3-year leases, so they provide stable income. Our hotel assets, obviously, we can adjust the room rates on a dynamic basis daily, so which means we're able to capture the growth very quickly. We are seeing actually with the improved visitor arrivals into Singapore. Last year was 13.6 million. This year, the expectation is 15 to 16 million. For the first half of this year, visitor arrivals were a little bit over 8 million. So we're seeing our retailers basically look at the numbers. They're looking at the performance. So so we are seeing rental growth coming through for our retail assets as well. So retail and hospitality provide the upside. The office provides the stability. So that really is the key theme. So again, prime core assets, which allows us to be very resilient during times of volatility. And we can also ramp up rents and also room rates very quickly when the economy is improving quickly. Yeah. So key highlights. Revenue was 146.7 million. We saw a nearly 6% growth in revenue year on year. NPI growth was 1.6%. Now, I have to caveat that slightly. It actually, we had a property tax upward revision for our two hotels for the years 2022 and 2023. So then there was additional tax applied this year of 3 million on top of this NPI. If we actually had readjusted accordingly and had placed the property tax in their respective years, the NPI growth would have been nearly 4%. Again, we're looking at performance. If we look at performance, Singapore office performance is 95% for our office assets. Now, the market was trading at just below 94%. So we're trading a little bit above the market, and we still achieved a positive rent reversion. So over the last few quarters, we have been consistently achieving double-digit rental reversions. Hospitality segment grew nearly 13%, and revenue per available room, the RevPAR, also grew nearly 16% year on year. So, nice continuous growth. The Mandarin Gallery, our occupancy is back to 98.3%. Now, this is where occupancy was in 2019 pre-COVID. So we enjoyed a positive rental reversion in Mandarin Gallery of 28%. So we've averaged close to 30% over the last 4 quarters in terms of rental reversion. So essentially, we're seeing that growth coming through from our rents. Okay. On the capital management, so we see revenue having grown. NPI also has ticked up. Now, obviously, finance costs have actually also picked up nearly sort of 19%. Now, that really is because interest rates have remained fairly elevated. Going forwards, we do see interest rates coming off. A lot of the data coming out in the last 1 month has been very positive and will allow the Fed to go ahead with their cuts in the next 2 quarters of this year. MAS actually has come out earlier this week to say the core inflation in Singapore is also declining, which means they are also signaling that interest rate cuts are also sort of in the bag as well. So we should see this pressure of finance costs ease off next year and really kick in. So that will allow us to then see that fuel a growth in the distribution for next year. The amount available for distribution has dropped 15%. Now, the amount to be distributed, we actually did a top-up based on capital distribution. So then amount to be distributed dropped 11%. Now, I have to caveat this a little bit. Last year, we paid management fees 35% in units. And we had 65% in units, and we now moved it to 100% in cash. So that has a circa $3 million impact on this number, 51.3. So if you add it up, it'll be 54.3. Now, we actually did increase working capital retention to work on CapEx because cost of borrowing is quite expensive. So we've actually been a bit prudent and just retained that component. So that's an additional 2 million. So earlier number was 54.3, so plus 2, that is 56.3. So we're pretty much nearly in line with the first half results, despite a near 19% increase in finance costs. Okay. Balance sheet, which remain fairly stable. Our NAV has remained flat as of compared to December 2023. Now, we've been very active in the first 6 months of the year. In May, we completed a refinancing. So it was a $540 million refinancing, but because the demand was so strong, we were 2 times oversubscribed at margins which are compressing as well. We decided to upsize it to 600 million and reduce our debt level for this year and also partially for next year. And then in June, we issued our first investment grade green bond. Now, our initial target was 150 million, pricing at 4.35%. But we were over 3 times oversubscribed at the close of the day. So we decided to upsize it to 250 million and tighten the pricing to 4.1%. So this was a 3-year bond that we issued. So very, very successful. Institutional investors accounted for nearly 3/4 of the final allocation. So typically bonds in Singapore are very much driven by private banks, which means the cost is a little bit higher because private bank clients expect higher yield, but because we have an investment grade rating, the institutional investors are happy to come in and basically are happy to accept our bonds at a lower pricing. We saw aggregate leverage actually decline a little bit as of end of the first half of this year. By the two sort of refinancing we did, we actually lengthened the term of our debt to 2.7 years. Nearly 70% of our borrowings are green financing. Now, if you look through that, all our interest coverage ratios, adjusted ICRs are still remaining quite healthy. Amount of unsecured debt, we've unencumbered a lot of it, so 87% currently. And if you look at this year, we have no refinancing risk. Next year, that 339, we've started discussion with banks. We don't see that any refinancing risk there to take that out. We're just sort of trying to get over our first half results and then start working on it in a month or two to take out the 2025 loan. So we should take care of that closer to the end of this year, or at least by first quarter of next year. Now the debt is actually due primarily in the second half of next year. The key takeaway here is 92.5% of our portfolio by value and also by revenue sits in Singapore. And on the far right, we have in the pie chart, again, that barbell strategy, we have 50% is office, and the other 50% is the hospitality and the retail segment, which allows us to see growth coming through over the next couple of quarters. We have a very well diversified tenant mix. There's no real over allocation in from any sector. Very well balanced here as well. We have completed most of the lease renewals for this year, and we're in advanced discussions for those that we haven't completed, and also for those leases which are expiring in the first quarter of next year. Okay. In terms of commercial segment, revenue did grow to circa 2%. Now, NPI actually has dropped year on year. That is because we actually some of our assets were on very low utility rates, and it actually had switched over into higher rates. But we completed a new utility contract for one of our larger assets last month. So that will kick in the second half of this year, and it's a 2-year contract, and we should see good savings there, and that will sort of improve the NPI margins as well for our overall portfolio. So the top 10 tenants, there's no concentration risk there, and there's one, the Deloitte Touche. They're in our downtown office, expiry 2026, but rents are pretty low, pretty far below the kind of sort of signing rents that we are doing at this point in time. So we see positive rent reversions in 2026 for Deloitte. Yeah. Okay. In terms of our overall office portfolio, so committed occupancy 95%, average passing rent has ticked up to 1057. Now again, positive rent reversions 11.7%. So moving downwards, the current CBD spot rents are 1195. So which means for the 2024 expiring rents 1128, I would say we're confident that we should still see rental reversion coming through as we're in advanced discussions there. The expiring rents of 1071, 1030 in 2025, 2026, because they're so far below the spot rents, and market occupancy is circa 94%. Supply is very tight. Demand still remains fairly healthy. So we should still see positive rent reversions coming through over the next couple of quarters. Okay. So we're seeing also nowadays, how do we actually reduce the void period, which means how long it takes to lease up office space, by fitting out certain spaces, especially the smaller 1,000 to 3,000 square feet spaces where new tenants are coming in, but they don't want to spend capex, but they're happy to pay higher rents, but want to move in quickly. So we've speculatively fitted out 1 or 2 units for every single asset, except for Bayfront, which is essentially fully let out. for downtown for One Raffles Place. So we fitted that out, and we've seen the demand come through very strongly for those, and we'll continue to do some fit out such that we can keep pushing our occupancy. ESG is an important component for our tenants, so they want to feel that they are part of the community. So we have a number of ESG events running, and as you can see in the photos here. The Mandarin Gallery performance has been strong. Rents are still holding up quite nicely and improving now. It essentially bottomed out in 2022, as you can see there. Again, sort of lease renewals for those in the remaining part of this year and towards the first quarter of next year, we are in advanced discussions with them. These are some of the things we've done for Mandarin Gallery. Rimowa has their flagship store at Mandarin Gallery. They've done really well. Tumi has done really well. Sneaker Dunk basically is a Japanese brand which actually sells sneakers, so vintage, high-end sneakers, and they do really well. The new store here is J. Lindenberg. They started in the second quarter of this year, and their sales are doing really well. MLB are expanding on the street front, and they are basically making the location here the flagship store for Singapore. Excuse me. The one sort of stress point for our portfolio really is the Shanghai asset. Now, the Shanghai asset, our committed occupancy, we've improved it from the last quarter to 76%, but rents are still under pressure, and there's a lot of supply in 2024. So we do see rents still coming off towards the end of the year as well. So our strategy there is to maintain occupancy. Now, the office component of our Shanghai asset represents 4.5% of our total income of the portfolio. Now, even if we were to say rents were automatically deducted or came off 30% tomorrow, that only represents a 1.5% impact on our total portfolio, which I feel is easily absorbed by the growth which we will see from our hospitality and also commercial assets in Singapore. Retail remains quite strong for our asset at 95%, and the reason is really because we're on a middle Huai Hai Road, and basically opposite us is the Hermes flagship store in Shanghai, so a very prime location. So that remains quite healthy. Yeah. Obviously, the segment that has performed well for us in the first half of this year is the hospitality segment. We see 13% growth in revenue, 6% in net property income, and both our two hotels, we're seeing strong RevPAR growth year on year, and also compared to the full year 2019 number. As you can see, for the Hilton is 291 versus 216. Crowne Plaza is still improving, and our overall portfolio, you can see it was 209, and now it's 269, sort of post-COVID. So we still believe, with improved visitor arrivals coming through, this will continue to drive RevPAR. Yeah. By geography, our three sort of main geo source groups coming through are the North Americans, which is from the US, essentially. North Asia, the majority of that, 80% of that, 85% of that is from China. Southeast Asia, half of that is from Indonesia. So the three countries represent circa sort of 50% of our total guests across our portfolio. And we're seeing the Chinese still arriving quite strongly. So they're driving they're obviously driving the growth as well in the Singapore hospitality market. The wholesale, corporate, and transient, quite a healthy balance there. Okay. Our Crowne Plaza Changi Airport won the world's best airport hotel for 9 years in a row earlier this year. So it's awarded by Skytrax, which is globally recognized. We've done a number of events at the Hilton Singapore Orchard as well. For CVET voted it as a top meeting hotel in 2024. Below are the various offerings which we're doing for to promote our F&B offering in the 2 hotels, and also guest stays. Our Crown Plaza Changi Airport, in one of the pictures there, you can see it's very popular for staycations. Parents like to take their younger kids there, and you can actually sit by the sort of full floor to ceiling windows, and actually it's pretty much soundproof. You can see planes taking off and landing all day long. So really popular. Yeah. Okay. Now, in terms of growth strategies, a little bit of market outlook. The Singapore office will remain resilient going forwards over the next, I would say for the remaining part of this year. Supply is very tight. The landlords which currently have enjoy high occupancy will benefit because currently the environment is a lot of tenants do not want to spend additional capital expenditure to do fit outs because it's expensive and they rather not do that. So renewals are quite, are very common. So tenants are a lot more sticky. And for, the supply, there's very little supply. There was actually a net absorption for the first half of the year. Rental growth, personally, I think it's probably going to be flat for the remaining part of this year. Visitor arrivals, I touched on, it's on track and it's actually doing better than last year. The first half of the year, there were a lot of events, which meant typically the first half is a little bit slower, second half is stronger for hospitality. So first half has been quite strong because we had Taylor Swift, we had Coldplay, a number of concerts. In the second half of the year, obviously there's F1 where we expect 250,000 visitors. Currently, I mean, all the tickets are sold out for the F1, and that the concert headliners have still yet to be announced. So we believe once that's announced, we will see stronger demand coming through for that as well. We in the fourth quarter of this year, we have the Singapore FinTech Festival that should bring in 60,000 delegates as well coming through. So there are quite a number of events coming through. Yesterday, a friend offered to help me get Andy Lau tickets. So he's going to be here 10, 11, 12, and 13th of October. But I took an hour, and then by the time I decided, he said, "Sorry, it's sold out already." So we went really quickly. Look in the near term, sort of, hospitality and retail, really, it's more the labor shortage issue in Singapore. And also sort of operating costs are higher, but we're seeing utility rates also, come off, and with core inflation actually declining, as MAS has mentioned, we should see that pressure ease off. Shanghai, I touched on earlier. Again, our strategy there is to maintain occupancy. Yeah. So, okay, what are our sort of 3 key pillars for us? So first one is how do we maximize asset performance? So we successfully completed asset enhancements for both hotels, and we're seeing the benefits of those 2 hotels in the first half of the year. Then we're looking at what else we can do with all our other assets to see what else we can do to improve it. We're focused on tenant retention. How do we optimize occupancy, minimize any downtime between tenants leaving, finding new tenants, so making sure our income comes through really good. We're in the process of reviewing our GreenMark renewals. GreenMark is the environmental credential provided by the Building and Construction Authority, BCA of Singapore. We're looking at how to upgrade it to platinum, a lot of the platinum, and to SLE. Basically, that will allow us to future-proof because a lot of the multinational tenants are requiring not just green credentials, but higher green credentials going forwards, right? Optimizing cost of debt and managing our refinancing. I touched on that a lot earlier. We've done a lot of work, and to reiterate, S&P, we've shared a lot of the numbers with S&P, and they're confident of our outlook over the next 18 months. And the strength of our balance sheet as well. So we'll continue to do what we've done successfully over the next 12, 18 months and continue to do so, right? In terms of value creation, I do think a lot of the stress in the market has happened. A lot of the repricing is taking place. So the healing process is starting right now. What do we like? We're actually looking to increase the proportion of our hospitality contribution from circa 33% now to 40%. Part of that will come from the growth of our 2 hotels, and part of that growth will also come from acquisitions. Now, obviously, if to acquire at this point in time, our price book is is trading quite far below parity. So really, the how we'll do it is essentially recycling capital and divesting some asset and then using it to acquire another asset. The key areas which we like is obviously Singapore hotels. We do like Sydney hotels. Hong Kong is looking quite interesting. Japan, naturally. The UK, yes, but probably less so. I think there's quite a lot of a lot of work that needs to be done by the new government, and we need to get comfortable with that. Right? So, okay, I think that pretty much covers it. Happy to take questions.
Hey, thank you, Mr. Tan. I think we already got some questions. Let's just start with the first one. I think before I go through the questions, Mr. Tan, will the slide be shared to the client, our clients? Can it be shared?
Yes, for sure.
Yeah, so we'll send out later once the briefing is over, we'll send it to all of you to have registered with us. Okay,
Yep.
I think first question probably think is I think it's been 10 years, like yeah, this is your 10-year anniversary, right?
Yes, that's correct.
So I think they're talking about despite the growth in your assets, share prices is below the IPO price and DPO has been declining. Is there any strategies that you want to on how you guys gonna address this sort of issues? Just
So, so to grow DPU, there are a few sort of strategy. Obviously, growing the top line, the revenue, allows us to grow the DPU, and also managing the OpEx, right? Managing expenses, and increasing the net property income. Now, one of that, and also one of the key component or one of the key expenses really is finance costs, right? We've seen finance costs grow 18.5% year on year. Now, that's not ideal, but we do think, we've seen sort of pretty much we're at maximum pain in terms of finance costs already. We should see that coming off. And when that comes off, that will fuel DPU growth. As I've mentioned, we should still see positive rent reversions for our Singapore office and also our retail asset in Singapore. So that will provide the growth. And with increased visitor arrivals now, visitor arrivals were 19 million back in 2019. So expectation this year is 15 to 16 million. So we're still short of that 2019 number where visitor arrivals were 19 million. So that continued growth in visitor arrivals will allow us to push our RevPAR growth for our two hotels. So that will provide that growth. In terms of cost, as I mentioned, we're doing quite a lot to lower the cost. Getting an investment grade rating means banks are also happy to provide cheaper financing to us. Institutional fixed income investors are also happy to provide cheaper financing to us because they recognize the strength of our balance sheet. So that's what we're doing. Pushing rents, pushing room rates as much as we can is also another strategy for us to improve the top line. So trying to manage the top line and also the expenses, right? And that will allow us to really sort of, push and drive that DPU growth. Obviously, recycling capital of older assets which we think we've come to the end of the business plan, and recycle into assets which are higher yielding is also another strategy.
okay, so basically growing your top line through, I think a lot of that will be driven by the hospitality segment, right? And of course, managing your costs. Okay.
Yes.
I think there's another question on sorry, your weighted average lease expiry is of 2.8 years. How is it comparing to the industry? Is it?
Yeah, I think it's a I think we're definitely in line with the industry because you have to understand, average leases in Singapore, the typical leases are 3 years. So at any point in time, you will have some leases expiring. So it really is not possible to get a three-year WALE in Singapore unless it is fully let to one single tenant for, let's say, at that point in time, or for a 5-10 year period, right? But because we're multi-tenanted, so that multi-tenant situation also allows us not to be overexposed to a single tenant and also allows us to continually capture any growth in rents as well. So 2.8 is very healthy. 2.5, 2.8, these are sort of very healthy numbers.
Okay. And I think you talk about your Shanghai situation a bit. I think there's a question, is there any intention to sell if rents remain weak for the next 2 years or so?
Yeah, I mean, if we made a very good offer, and there's another asset which we can acquire, we can take the funds and acquire it, and it's definitely positive acquisition, positive accretion then yeah, for sure. I mean, we'll definitely look at it seriously, right? I mean, we owe it to all our unit holders or our shareholders, basically, to optimize the performance of the REIT, really. And recycling capital is, is one of the strategies which is definitely on the books for us.
Okay. There's also a question whether you guys are looking to work with local hotel operators outside of Singapore.
No, currently I would say, look, we do prefer international brands because they generate quite a very strong sales team. For instance, the Hilton has a worldwide sales team basically based out of Shanghai, which pushes a lot of Chinese guests through to our hotel as well. So we do like that international brand because it does allow us to tap into the corporate market as well. So whether that's European or the Americans, multinational. So there's a benefit to that, and benefit in terms of scale for marketing the brands, the reach of the various brands as well, international brands. That does provide a very strong competitive advantage.
Okay. And I know you talk about the recovery, like the growth driven by the hospitality segment, and I think we've seen that quite a bit in terms of the from your revenue growth, and but your DPU is still not that. I mean, I think there was a sharp drop in 11%. Could you pinpoint what's the key reason for that decline? Like I mean, and how long, or should I say, when can investors expect to see it sort of like a turnaround, right?
Yeah, look, I mean, we are, if you look at it on the top line, we're managing the top line, we're growing that top line, right? Expenses excluding finance, we're managing it also pretty well. It really is the finance cost, and finance cost is a function of, is really a function of what the Fed does really globally. When the Fed pushes, most countries are forced to increase their interest rates. Otherwise, there'll be a devaluation of their currency, as we've seen in Japan. Sort of, the currency has devalued tremendously over the last 1 year, 6 months. That is really one of the key drivers, because financing is really one of the key ingredients for a REIT, right? And currently our hedging is we're at 60%. We can hedge to 70-80%, but it doesn't really make a lot of sense. Yes, there is, we do think going forwards over the next 2-3 months, actually interest rates will drop, and we should be able to put in hedges at much lower rates and enjoy and capture that decline in interest rates. So, and that will translate essentially to lower finance costs, right? So after the Fed cuts, if they cut, let's say in September, October, then obviously the benefit of that cut is only in one quarter. So you don't see it over the full year, but for that quarter, you definitely do. But if the rate continues to be cut, then definitely next year, we'll see finance costs come down significantly, depending on how much the Fed cuts. And that really will fully translate into, all of that will just translate into an increase in distribution. So a 25 basis point cut, decline in interest rate, basically is a 0.04 impact on our 0.04 cent impact on our DPU. So if you look at it here, 0.04 is roughly 4.5%, right?
Okay. I mean, with some of these assumptions that you have, are you able to, do you have like an internal target for your growth for your net property income and your DPU?
No, we don't really put a target. I mean, we just push as hard as we can, really.
Okay. No, it's nice. And is there any acquisition in the near term? I mean, especially.
I mean, we're monitoring the market, obviously, closely. A number of locations, it's still not positive carry, because interest rates, in Hong Kong, probably you can buy a hotel at 6% yield, but cost of debt is sort of 6.25, 6.5. Very similar story in Australia as well. The only location currently is Japan, where interest rates are quite low and it's positive carry, but the market is very tight, and there's a lot of capital chasing very few hotels. So we have to be quite careful that we don't go in and overpay for a hotel in Japan either. So we don't need to grow for this, acquire for the sake of acquisition, right? I think it's important. Like if interest rates remain fairly high for a little bit more, I think we want to be safe rather than aggressively chase that growth, because we'll still see that growth in our portfolio, right? Because the prime core nature of our asset means we will see that growth coming through.
Okay. And just wondering, what should investors pay attention to see whether you guys will look into acquisition? What should we pay attention to? Interest rate cut, or I don't know.
Yeah, I mean, definitely interest rate cuts will free up, will allow that DPU growth, and then hopefully, then that allows us to be able to be positioned to acquire accretively as well. So that's definitely sort of, I would say right now at this point in time, we're still pushing the top line, but really the key sort of difference or change that can happen here is if finance cost starts coming down, then the performance of the REIT you'll see a very nice sort of improvement there. So are we under stress for the finance cost? No, we're not. Does it drag on our DPU? Yes, it does, right? But once that comes off, then we'll really see it, the performance of the DPU improve strongly.
Okay, I think there's a question on your Mandarin Gallery. This is regarding, I think, Valiram Group that owns at least 3 brands at Mandarin Gallery, your Michael Kors and Victoria's Secret. So is there a concern in terms of risk if the 3 brands pull out of, if the group decides to? Is that such?
No, not at all. All the big all the big French European brands have inquired, whether they can take that space. So we'll lease it out tomorrow if any of that goes. There's at zero concern. We don't actually even think about it, because we're really that's really prime location.
Yeah, I do kind of agree, because I was been there quite a few times as well. So really a strategic place to be. All right, I think there's a question on the rationale of expanding in your hospitality segment for you guys, and what strength did you have that, as compared to other REITs?
So why invest in hospitality? Look, I think Asia has a growing middle class, and that middle class will continue to grow, right? So when you have a roof over your head, you have shelter, you have food in your stomach, what do? You travel. And normally people travel to neighboring cities or the close by destinations. So Singapore being in the middle of a very large ASEAN, Thailand has 70, 80 million people. Indonesia has 250, 300 million people, so it's 600 plus million in ASEAN, right? And and Singapore is a destination for them to visit for business, for medical. We see a lot of medical tourism, for hospitality in Singapore. But as an overall Asia Pacific, I would say, um, people will continue to travel to Tokyo, to Sydney. So we like these kind of destinations where, if you Google it, they are on the top 10 of most visited cities in Asia Pacific, in the world, right? So we like these type of locations, and we think going forwards, the fundamental demand will be there for the next 5, 10 years because of that structural shift in income, right? And that growing middle class. So we believe that is that will be well positioned. And I think the risk of hotels, everyone has seen that. We've gone through COVID, hotels were shut for 1, 2 years, and and it's everyone thought hotels would collapse, but it's actually come through even stronger post COVID. So we believe it's very resilient, actually.
Okay.
Right.
There's a question on the change of the base management fees from 65% to 100%. Do you want to explain that?
Yeah, so we did that with the rationale that, look, instead of issuing units, which means sort of diluting the base, and the overall impact over the years will mean actually the DPU will decline because there are more units to be divided across. So we actually pay it out in cash. Now, obviously, in the near term, the impact is actually the DPU does drop in the earlier years, but we're not, I guess someone sort of explained it to me like this. Let's say you have 3 kids and you're feeding the 3 kids, and you decide suddenly to have another child every year. So but your income hasn't grown that much, so the amount of money you can use to feed each child actually decreases. So then that is your DPU declining. So that really is sort of a very sort of simple illustration of why we've done that.
Okay. And I think there's the questions whether you guys are looking to invest in different assets in different cities that you would probably wanted to strengthen your investment or exposure.
Yeah, we do like hotels. I mean, right now, really the preference is for hotels because we do want to grow our income from 33 to 40% for in the hospitality segment, right?
When is that the target until from 30
Over the next couple of years. Now, we will probably, 33 to 40%. Half of that will come from the organic growth in our two hotels. I would say over the next 2, 3 years. And then the balance would, be an acquisition of one hotel if we wanted to. OUE, on the sponsor side, they were awarded a 250 room key hotel at Terminal 2. That should be delivered in 2028. So we have a right of first refusal on that. So we can choose to acquire that as well, down the line in 2028.
I think you mentioned just now, I think this question, your borrowing, how much percentage is it based on floating interest rate?
So we've hedged 60% fixed rates and 40% floating. So we don't really want to push up that fixed rate because when interest rates start coming down, we want to benefit from that. We don't want to be caught having hedged at a higher rate, right? And not benefiting from it.
Okay. But how is it compared to the industry? Is it higher or lower in terms of your?
I would say we're roughly there, really. Most streets are in and around that level, or might be some a little bit higher, some a little bit lower, but yeah.
Okay. And is there any potential asset injection from the sponsor?
Just one. I mean, we have as I shared earlier, the Terminal 2 hotel. That was awarded earlier this year, so it will take 4 years to build. So completion will be 2028.
No, 2028. Okay. And the thing there's a question, I'm not sure if you can answer this. If someone were to invest into OUE REIT now, what do you expect in terms of the growth rate like over the next 5 years?
Uh, not really sure actually, to be honest. I mean, we typically distribute, north of 6%. So in terms of dividend yield, so that is 6% there. If you think that we can grow, by 10% in terms of our DPU over the next couple of years because finance costs have come down, revenue has moved up, then it's 10 plus 16, so 16% per annum over the next couple of years.
Okay. And earlier you talked a bit on your green financing strategies. Just wondering, how different is it in terms of the rate? Is it cheaper, and what sort of benefit does it give you guys?
Yeah, if we hit certain targets on emission targets for water, for energy emissions, we have interest rate savings on that on
Oh,
our
okay.
loans. Yeah.
And sorry, and how stressed is this target? Is it something that you guys are confident of achieving?
These are naturally stretched, but we do think we can achieve it. I mean, well, we have achieved some of them in the first half of this year, so we've enjoyed some savings from that already.
Oh, but already enjoy some of the savings from that lah.
Hmm.
Okay, sorry, what's the difference in terms of the rate? Is that huge or just a bit?
I can't really comment on that. We have an NDA with the banks, so I won't be able to share that. Yeah.
Okay, no worries. And just wondering, I mean, that you talk a bit, I think you talk about some of the asset enhancement initiatives for the hotels. How is it translating into your return? Is it
Oh,
is
it's excellent. I mean, I would say, we are hitting sort of our double-digit return expectations when we did the underwriting, right? I mean, if you look at the hospitality segment under RevPAR, 20, the gray for the Hilton Singapore Orchard, that's a 2019 RevPAR, right? So now, so we rebranded from the Mandarin to the Hilton Singapore Orchard, and and we're seeing RevPAR having grown from 216 to 291 basically, right? And remember, we're on track to hit maybe 16 million visitor arrivals this year. 2019 visitor arrivals were 19 million, so 3 million more, right? So which means we're able to push room rates up. Part of that obviously is a recalibration in room rates, but it's also because we've been able to push it up. So the Hilton, for instance, it was in the past, it was very much a regional hotel. It would do really well during peak holiday season, school holidays, etc. But that meant earnings was lumpy, right? Because it was seasonal demand. So we would then back then backfill up the space with air crew, large low-cost tour groups. So then that basically reduced the RevPAR because the rates dropped during the low season. So post rebranding, we were then able to actually fill up, enjoy still the peak seasons, but fill up these low seasons with corporate travelers. Hilton is a very strong corporate hotel. So we're seeing that coming through. We're not taking air crew. We don't do large low-cost tour groups anymore. So we do MICE events. We do FIT travelers. So because again of the branding, right? We touched on will local brand or international. So that allows us to tap into the corporate market. It allows us to tap into the brand recognition for independent travelers as well coming through. So the combination of all that allows us to have grown the RevPAR from 216 to 291. Again, at where visitor arrivals are still not are probably 20% off where they were in 2019, right?
And just wondering, because your RevPAR gone up quite a lot. Just wondering, is it more or less at the peak, or are you still expecting to see continue go up?
Look, I mean, if we assume the average room rates stay the same, but visitor arrivals improve another 10%, then you'll see that RevPAR grow 10%, right? Translates accordingly. So that I would say the sort of room rates, I would say we're in around sort of where room rates are. I think they were to stabilize. Again, we will grow at a nice sort of pre-COVID growth, 5-6% per annum, 7% per annum in terms of room rate growth. But what we're going to see, is still over the next 1 year, visitor arrivals continue to improve. And hopefully hit that 19 million number, which was a 2019 number. We speak to the Changi Airport Group because they are our landlord. We lease the land from them for the Crown Plaza Changi Airport, and they're planning once the Terminal 5 opens to have 95 million passengers sort of come through Singapore per annum, right? Which is quite a large pickup from where they are. They're at 60 plus million now. So by 2030-ish, they should be there. So anticipating quite strong growth coming through. So if their estimations are correct, then we will see the visitor arrivals improve in Singapore. Again, the growth in supply is actually not as strong. It's still below the pre-COVID growth of 4.4%. The next 3 years, this year and the next 2 years, the CAGR growth is 3.6%. So it's still below that 4.4% of the 2014 to 2019 number. So supply remains lower than what it used to be. So that would actually hold up the room rates. And with improved, if we believe on the longer term, visitor arrivals are going to continue to improve, then that will actually help push up room rates and RevPAR as well.
Okay. I think there's a question on whether is there any plan for OUE to enter into the data center space given the demand?
No, that data center space, it's a very specialized field. To do that really well, as you actually have to have access to energy, to power, and power sort of relatively cheaply if you can afford it. Can get it done, then that makes a lot of sense, right? We don't have that capability, so we will not be steering in that direction.
I think there's one key risk I want to ask you about in terms of, since there's a lot of dependency on the hospitality segment, is there concern that if a recession were to hit that might hurt the hospitality segment? Because right now I think a lot of that's gonna be the growth gonna be driven from that side, right?
Naturally a recession would mean sort of slower travel. So yes, I mean that'll be the answer, but we don't see that that huge drop off because again corporate travelers do have to travel for the Hilton medical. There's a fairly large component of medical tourism, medical tourists staying there because Mount Elizabeth is right next door, and also in Paragon they have the medical suites, which a lot of the regional tourists come through for medical stay, and they stay for a week, 2 weeks, a month. So that would, they're coming because they need to take care of themselves. Corporate travelers are still coming, so we have at least a base there. Our Crown Plaza Changi Airport, look, if you're coming through, you're flying in from the US going to Australia, we're the only hotel that has a pool, And a lot of the travelers like to use the pool. They like to stay there, lay over for half a day, and and it's quite popular. We're next to the Jewel, so you can stay there, go to the Jewel. What we're seeing now is actually a lot of the Chinese tourists, they're choosing to stay. Let's say they stay 3 nights in Singapore, they'll do 2 nights in the city, and then they'll stay 1 night at the Crown Plaza because they'll the kids can see the planes go up and down, and then they can go shopping at the Jewel before they fly back, right?
I mean, speaking of the Chinese tourists, have you seen are they coming back already? Like,
Yeah, they are. They're back in a fairly large way. From memory, they're about 77% of pre-COVID now in terms of their arrivals, the levels. So they've been coming back. The visa earlier this year, where the 30-day free visa travel from China into Singapore actually really sort of pushed up the visitor arrivals from China, and also the lifting capacity to from China to Singapore is pretty much fully back to the pre-COVID levels already.
okay. There's a
Yeah.
question regarding whether there's a concern on the regulatory part, where I think if the Singapore government want to change the policy of banning short-term rental like Airbnb,
I mean,
is that something that you guys look into?
not really. I mean, we don't really, if they ban Airbnb, I guess it'll benefit hotels even more, really.
Oh,
I
really?
mean, yeah, because if they ban Airbnb, visitors coming through, then they can't get to stay in Airbnbs, they have to stay in a hotel.
No, no, sorry. I think the question is, I think right now the government ban Airbnb. What if they lift the ban?
I mean, at this point in time, I don't think there will be. I don't think that the government will lift it because, uh, in terms of supply for housing, it's still fairly demand is still outstrips supply at this point in time. Although rents have started moderating, you have to understand rents shot up really quickly over the last 2 years, and affordability is a key concern. Um, of not just the Singapore government but governments around the world. I mean, housing affordability is a key concern. Yeah.
Okay. Can you share the current occupancy rate for Crown Plaza T2 and the range of the RevPAR?
I mean the RevPAR for T2, our T2 is not open. I mean it's just been awarded. So
Yeah. Okay.
yeah.
And I want to ask this, sorry, just give me a sec. Yeah, I want to ask this question because I think whenever I talk to investors, there's this concern, right? If interest rates were to remain higher for longer, right? Do we expect your interest cost, is it going to continue to go up, or this is the level that we can expect it to stay, you know?
Yeah, we believe, this probably, in and around the levels that it would be hovering at, for if interest rates were to stay higher for longer.
No, so this is more or less well, I can say this is probably the peak of the cost today, lah, right?
Yeah, I mean, we're not going to see sort of massive increases anymore, unless the Fed decides to increase the rates and then SORA goes up, base rates in Singapore goes up, then yes, it will. But I think the probability of that happening is very low. I think there's a much higher chance of rates coming off, rather than rates going up at this point in time.
Okay. So I think they're asking for the Crown Plaza Changi, the current occupancy rate and the range of the RevPAR.
Yeah, I mean we have the RevPAR,
We just now, right?
yeah, so at 228. I mean we can't share the occupancy, but that's our RevPAR.
Mm. Quite a significant growth, then.
Yes. So so it's coming along nicely, right? The first half was what was doing quite well, and you have to understand, airport hotels don't really benefit from concerts because they're so far away from the from the national stadium or indoor stadium, right? So it really is very much the airport business.
Okay.
Mm.
And last but not least, I just want to ask this, what are some of the key risks that investors should pay attention to? And of course, any sign of turnaround, what should they look for? I'm guessing the interest rate cut will be the first sign that, it's time to buy in. But before that, is there anything else that investors should look out to in your view? So
I would say, for our portfolio, really that's it. I mean, I've shared the risk on China, that actually if rents do decline, but look, the China office component is 4.5% of our portfolio income. So if rents were to drop 30% tomorrow, it's 1.5% impact, which the rest of the portfolio will be able to absorb. It will not be ideal, but it's not, in my view, it's not a material risk. If you talk through valuations, supply is very tight in Singapore. Performance is still coming through, so we don't see that. We don't see valuations drop in Singapore because look, we're still doing double-digit rental reversion for our office. We're doing 30% for our Mandarin Gallery, so there's no reason for valuations to drop. So that we don't really see sort of risk coming through from performance. Maybe the only risk really is for hospitality is if Singapore keeps getting even more expensive, then maybe tourists will decide, oh, they might want to stay away, right? I mean that really is one of the risks. But with core inflation coming off, that should sort of come down as well. Yeah.
Okay, I think this is probably a no, but I'm just going to ask you, would you consider raising funds from unit holders to reduce debt level, since that's
No, I
but
mean, look, we're a price book sort of 0.5, right? And it's really dilutive. It'll really harm our existing shareholders for us to do that, right? Really what we want to do is improve the overall performance, improve the DPU growth, and if we close our sort of share price to 60 cents, which is where NAV is, then yes, we can think about issuing units to fund acquisitions. To pay debt, we don't need to do that to pay debt. I mean, our debt level is very comfortable, 38%. There is no gearing risk, right? There really is no gearing risk. So yeah.
Okay, I think that's all for the night. Thank you for joining us today, everyone else. Appreciate your attendance. We hope this webinar has been insightful to you. If you have any further questions, feel free to just drop us an email. All right. Thank you, Mr. Han. Thank you, guys. Everyone.
Thank you,
Bye.
Billy. Good evening,
Bye.
everyone.